Hey everybody, this is Brent from Wolf on Wall Street Trade with a video that I think is going to be kind of brief. It's just kind of a follow-up to last weekend's video. And again, a little PSA, we're not going to be Wolf on Wall Street Trade much longer. I had this website name actually about 3 years before the movie of a very similar name came out. And it has made SEO optimization, Google search just a nightmare. So a new website is coming out. Taking a little bit longer than I was hoping, but it should be out by the next month or so before the end of the year, and a lot of new features, and I think it's going to be really fantastic. In any case, if you're a current subscriber, you are grandfathered in at the current price, which has been the same since 2008. If you become a subscriber before the new website goes live, you'll be grandfathered in at the new price too. Otherwise, I am raising the price a little bit because I haven't raised it since 2008. Inflation, yada, yada, yada. In any case, so I'm going to just play you a quick excerpt from last weekend's video so you don't have to go back and watch the whole thing. You know basically what the gist is of what I was looking for. Or if you have the time, go back and watch it. I think it's helpful to see how things develop and how we look at the market. And I'm not ever looking to make people reliant on me. So I share everything with my subscribers. I want them to understand the concepts and be able to apply them from themselves, because it doesn't matter if you're a day trader. It doesn't matter if you're a long-term investor. All these concepts are fractal, so they work for all of them. In any case, let's get to this little clip from last weekend.
Again, I can reveal that the first target of ours at 4,000 was hit right on the nose on Friday. It's amazing how price, if you understand what price is doing and you understand the price patterns like these bull flags, the measured moves from these things are just phenomenal. As a matter of fact, the measured move for that 4,000 level came from this bull flag right here. 4,000 right on the nose. I do think the market has maybe run a little bit too far, a little bit too fast. I would like to see the market consolidate here. The S&P could come down to 3,900.
That's key.
Draw in some new shorts.
That's key.
Consolidate the gains, shake out the weak hands.
That's key.
And then, again, we do have a higher target. I can't reveal that. For members, you know what it is, but when we hit it, I'll let you know. So we saw a huge short squeeze. I think if we get a little consolidation, shorts will jump back in, and they can power the next move up. But I would like to see that consolidation. I don't like to see stocks go parabolic. I like to see them advance, consolidate, advance, consolidate, advance, consolidate, advance. You're building structure, you're building support. So this was former resistance right here. That should be support. So if it came down to 3,900, fine with me. But I would like to see that, and I think we will see that probably coming in the next week or so.
Okay, so hopefully that's pretty self-explanatory. This is what the market looked like as of the video I did last weekend. The S&P had just hit that 4,000 target, looking for the pullback. So let's see what happened this week. And remember all the little things I said, that's key, that's key, that's key. And I'll show you why. Here is a 30-minute chart of the S&P 500. A lot of you may notice that I use a lot of intraday charts rather than daily, although I look at those too. It's because you can see all this price structure, the things happening here, like these bull flags. This was where we were last weekend at that 4,000 level. I said I was looking for a consolidation. It could come all the way down to 3,900. I'd be fine. And I was expecting that it would be a bullish consolidation. But, you know, you have to watch what price action does, what the indicators say. What did we get here? We got a bull flag, and it was right between 4,000 and didn't even really test down to 3,900. It stayed above that. I was fine with it coming down to 3,900. Even a little bit below would be fine for me. But what happened was the S&P 500 found technical support. Oh, it was funny. When I first got into technical analysis, you know, back in the late 90s, it was called voodoo analysis. Like, people were really into fundamentals and stuff. They're like, oh, how can a bunch of squiggly lines on a chart tell you anything about what price is going to do? And moving averages, you know, what do they mean? Well, it's where technical traders step in. So let me just show you the S&P 500 on a daily chart. And here it is with a 100-day simple moving average in light blue. Here is the week. This is the pullback that formed that little bull flag. And there is support. I mean, right on the nose at the 100-day SMA, simple moving average. Technical levels matter. You can see it was resistance here, support here. It doesn't mean that, every time they're like a golden ticket, it's like some magical thing. But no, it's where technical traders step in. And there's also a psychological component, levels like 4,000, for example, whole numbers, 3,900. So if you go shopping in a store, you never see something on sale for $10. It's always $9.99 because the human mind gravitates towards whole numbers. And even though it's only a penny, $10 seems like more than $9.99. So that's just a psychological component that retailers have been aware of, but it also plays a role in technical analysis of stock markets and whatever else you choose to trade. So let me jump back to those intraday charts. We'll look at the rest of the averages real quick. And again, there's the S&P 500. That's a bull flag over here. See what it did? There's the flag pole. This is the flag. So it is a downward sloping parallelogram, but you need a strong move before it. That's like the flagpole. This looks like a flag flying. Same thing over here, and there's the flag flying. That is a bullish consolidation. It's one of the really powerful bullish consolidations. In fact, sometimes you see them on daily charts. Sometimes you see them on intraday charts. This is what I mean about these concepts all being fractal, because price is a representation of mass psychology. The reason these patterns have worked for hundreds of years, because Japanese rice traders, Japanese candlesticks came from Japanese rice traders hundreds of years ago. The reason these patterns work is because they are a reflection of human psychology. Price is a reflection of human mass sentiment about everything that's known at the time about the market. Take a look at a couple of the other averages. Here's the NASDAQ 100. What do you see? Another bull flag. By the way, that is a measured move target. You can't see how high it goes. That's for my subscribers. But this is a measured move target that is based on this base here. And this trend line right here is the neckline of this base. So that is like the breakout point. Price respected that. Pulled back just a little bit below it. Look where it ended the week. Just right above it. So perfect price action there. Very happy with it. Bullish bull flag here. And again, you can see that flagpole and the downward sloping parallelogram that looks like a flag that's flying on a flagpole. That's why they call it a bull flag. And while I think the base here is more important as far as the measured move, you can really get a very accurate measured move from these. I see these all the time, and they hit that measured move almost every single time. I'd say 85-90% of the time they hit the measured move. Sometimes they'll go a little bit past it, and then they'll come down and consolidate right in the area of the measured move. Here is the Dow Jones Industrial Average. A little bit different consolidation, but it is kind of like a bullish flag again, a parallelogram. Remember, here's another one over here. Remember, the Dow hit that measured move. It exceeded it. Look what it did. It came down, consolidated right around that measured move before it made its next leg up. On the week, I was looking for a consolidation correction pattern, right? And was anticipating that it would be bullish. We do have the bullish flags. The Dow was virtually unchanged. The S&P was down 0.7%. NASDAQ 100 was down just a hair over 1%. And small caps were down 1.7%. Remember what I said in the video, that I think it would be helpful if we did get this consolidation this week, which we did, that it will draw in new shorts, okay? Because we had, the prior week, we had a historic short squeeze. One of the biggest, for Goldman Sachs most shorted index, the biggest short squeeze ever on record. So I'm going to show you the most shorted index real quick, and we'll see if what I thought was going to happen, happened. So what we're looking at is the S&P 500 in the red and green candlesticks, and the white line is my own most shorted index. So this is this week, huge short action. Right over here, you can see the shorts jumping in at the open. So probably more than half of last week's historic short squeeze was retraced. That means the shorts are jumping back in. That's what I was looking for to happen, because when we have a bullish consolidation, one of the things that will propel it forward is short covering. So if we get a breakout from those bull flags, the shorts will start covering. The more they start covering, and to cover, that means they have to buy, the more shorts will be underwater, and the more shorts will start covering again. So it just kind of feeds on itself. This all represents potential buying, because to get out of a short position, you have to buy to cover. So they start getting at a loss, they have to buy. That pushes stocks higher. Another thing that was interesting this week was sector performance. So if you look at how the sectors did, the 11 S&P sectors, they had a defensive bias. So that means the counter cyclicals, or the defensive sectors, utilities, consumer staples, healthcare, they all outperformed on the week, up 1 to 1.5%. Not big moves, but that just shows the market was getting a little bit more defensive as it was pulling back. As far as the mega cap index, it only underperformed the S&P equal weight index by 30 basis points on the week. That's nothing. It outperformed the week before when we had that huge move by 300 basis points. You pull up this most shorted index again. I had the S&P 500 up, but remember I said the small caps underperformed on the week. They're domestically oriented. The majority of the stocks that are in the most shorted index are tend to be like small caps, mid caps. So you'll see big moves in the most shorted index will affect small caps the most. So here's SP 500 with the most shorted index in white. I'm going to change this to small caps IWM, and you'll see that the two track a little more similar than the S&P 500 does. So when you see big changes in the most shorted index, it usually affects small caps the most. I was looking for a consolidation correction. If you watch more of last week's video, you'll see why I thought it would have a bullish bias going into this week, this consolidation week. And I will show you a few charts. What we want to do is just look at the objective evidence. We see bullish price action here. It's a bullish consolidation. But we also want to look at the market signals, the indicators. Do they also confirm that? The more they confirm that, the higher the probabilities that this is not only a bullish consolidation, which we can already see, but the higher probability that it will break out and that it will do well. So let's take a look at some of the objective evidence that supports this bullish consolidation. I love watching the high yield credit markets. They tend to be like a window into what institutional money is doing, being that a lot of institutional traders will use high yield credit, HYG in particular, because it's very, very liquid, as a proxy for like S&P futures. So I watch the credit markets. This is a custom credit index. It's got about 6 different credit assets. So it just kind of takes a little bit of the noise out. That's why you look at indexes. They tend to give you like an average of what's going on rather than individual stocks, which can swing wildly. So if we look at the custom credit index in white here next to the S&P 500, what I see is a very bullish leading positive divergence. So we have credit doing better overall as the S&P is pulling back. And let me just zoom in a little bit closer. We have a positive divergence here. S&P is pulling back in that flag, and we're making a higher low over here in credit during that time. So that is constructive. Here's a quick little chart of the Dow Industrials and Dow Transports in blue. And this chart is normalized as of the first of the month. So normalized on the month. You can see what happened over here. The transports, which tend to lead industrials, led industrials higher, led the whole market higher, and they also kind of led lower into this pullback. That was one of the signals we were looking at. You should always look for confirmation between transports and industrials. So if the industrials who manufacture things are doing well, then the transports that ship those goods should also be confirming that. If they're not, that tends to be, a little area of concern. Overall, on the month, we still have transports, even though they pulled back more this week. They're still outperforming the industrials, or showing better relative performance here. Market breadth, so here we have the S&P 500, and in this white line is the percentage of NYSE stocks that are trading above their 200-day moving average. Huge. I mean, the most since January, when the S&P was way higher than it is now. So this still very constructive. That's good. This is the percentage of NYSE stocks trading 2 standard deviations above their 200-day moving average. There's no deterioration in these kind of breadth indicators. I track about 30. There is some deterioration in a few. That's supposed to happen on a pullback. But largely speaking, out of those 30 or so I follow, they all look like this. And this is in line with price, probably even a little bit better. I've been talking a lot about the US dollar index and yields because those are really the primary drivers of the market, especially for the mega caps. And I showed last weekend, I think, and maybe a little bit before that, I showed the breakdown in dollars. So this was a consolidation. That's all we needed to happen for the equity market to rally. But here's the breakdown on the CPI. We had a really small bear flag over here that kind of failed, but we still have this bearish consolidation here. I'm not quite sure exactly what it's going to be yet. Right now, it kind of looks like a maybe like a triangle of some sort with this kind of flat line here and then coming up over there. But this is a bearish consolidation. Again, here's the impulsive move. So if it was a bear flag, that would be like a flagpole upside down, the flagpole upside down, and then the parallelogram trading away from the initial or primary trend of that flag. Why is this helpful for stocks? Well, it's helpful for stocks because this is a bearish view of the dollar, and stocks have been trading with a strong negative correlation. So the dollar goes up, stocks tend to be under pressure. The dollar goes down, stocks tend to do better. We're getting a bearish kind of price pattern here in the dollar, suggesting that it's probably going lower at some point, which helps stocks. It also helps gold, so maybe we should take a look at that. I don't know if I said it on the video or not, but I've been telling my members, if stocks are going to rally, then gold's going to rally. And you can see a very similar base here, kind of like a W bottom at 1620 in gold. The reason why is even though they're not at all in the same asset type or class, so gold is more of a safe haven, whereas stocks are more of a risk asset, it's being driven by the same two things. Again, that inverse correlation with the US dollar and with US yields. There's the base at 1620. Here's a nice big move up towards 1800. That's an important psychological barrier for gold. So on the week, gold did the same thing as stocks. It pulled back. So let me show you a little closer view of this. And that's a 30-minute chart. Here's that base at 1620. Here's the 1800 level. You can see gold starting to pull back here finally a little bit. Those kind of longer upper wicks there, which says higher prices were being rejected, losing momentum. You can see the volume too doing the same thing. This is what you want to see on a consolidation or something that looks like a consolidation. You want to see volume coming down. You don't want to see like real erratic, kind of spiky, big red volume in here. You want to see it trend down like it's doing. I wasn't going to get into it in this video, but let's just take a look at Bitcoin real quick, because I've been saying, you know, don't like the price action there. I'll show you real quick. We'll look at Bitcoin futures. Bitcoin futures daily chart. You can see the bearish trend here. But what I've been looking at is this kind of lateral little range from about mid-June and the break of support when we had that FTX kind of meltdown in the Bahamas. That breakdown below that kind of lateral range, that's a bad thing. You see the big volume here. Take a little closer look at it. And that's a 4-hour chart. So this is kind of the area it broke down from, around 18K, which has been a key level. You can see the volume. This, again, this looks like a bearish, probably going to be like a triangle, like a symmetrical triangle. That is a bearish consolidation continuation pattern. Suggests that Bitcoin's got more downside to go. Crypto's got more downside to go. I haven't liked this for a long time. I would stay away from it on the long side for now. Okay, so let's get back on topic with the signals for the market. Let's look at SPY's 3C chart. This is the 2-minute chart. So this is more what I would, even though it sounds like a very short-term time frame, it really represents the trend. One of the reasons I thought that we would get a bullish consolidation this last week, from last weekend's video, is the strength in this 3C chart. So it's confirming with price very well. So I like to see that. That is a bullish development. ETF for the Dow. Still confirming, but a little bit more weakness here. And I think the Dow has really just outperformed probably more than it should at this point. And I think if rates come down a little bit more, then we're going to see the NASDAQ 100 play catch up. The Dow will probably come down a little bit. But it's not a bad chart. This is a little bit, iffy, but nothing too bad. It's nothing I'd be worried about. Pull up QQQ real quick. This is that chart. I wish I had more history on this chart. But this is what I was talking about last week, how 3C was going parabolic. In here, before price even broke out, there's the breakout. That is the flagpole. This is the flag. 3C on this chart is confirming or better. So that is another good sign. And here is small cap IWM. Again, another good sign. This actually looks a little bit more positive than the others on the week, because as price comes down over here, we have a little bit of a positive divergence. For members, Friday's afternoon update, I told you all the signals that I'm looking for, the leading market signals, including 3C on our shorter term tactical time frame charts. And when we see those fire off, then we have a really good idea that we're at an imminent point of like a breakout from that bull flag. For members, you know what those are. Just read Friday's afternoon update. I list them all there, and of course I update those for you in real time all throughout the week, all day, Monday through Friday. We were looking for a consolidation down to 3,900, and we were looking for a bullish consolidation. We have those. We're coming into a holiday week. We have Thanksgiving. Typically, holiday weeks have a bullish bias, but the volume's going to drop off. A lot of traders will make it a 4 or 5 day weekend. So you'll see volume drop off. I'd prefer that, volume didn't drop off during an attempted breakout. That's just the holiday seasonality. Typically has a bullish bias. Midterm election years, the year following that has a bullish bias. We have the Santa Claus rally kind of thing. So we have a very strong seasonal bullish bias going into the end of the year. The key thing is going to be the payrolls report that comes out in early December, because that's going to be the last real key piece of evidence. We've seen CPI show inflation slowing. We've seen the producer price index show inflation slowing. And the Fed has been worried about wage inflation. The last payrolls report from last month, the establishment survey the establishment report was just bunk. I mean, it's always goal seek. Nobody really takes it serious. It's a very political thing. But the household survey showed that the unemployment rate went up. It looks like the labor market is slowing, which is what the Fed wants to see. They want to see wages slow. They want to see the unemployment rate go higher, because that kills demand, that helps them defeat inflation. So that is the thing that is going to be key. That will be before the December FOMC. That will be the next key event towards the middle of the month. But that payrolls report, that's going to be a key report. We're moving into a seasonality. There's been a ton of layoffs. I read something just this past week that 40% of restaurants couldn't make their rent last month. So we're seeing the effects of Fed tightening. It usually takes 6 to 9 months for a rate hike to show up in the economy. So what we're seeing right now showing up in the economy are the rate hikes from March. So the ones that we just got, we're not going to see until next year. I think we'll continue to see the economy slow. We'll see demand come down. We'll see inflation come down. And then we'll see the Fed's rate hike trajectory start to come down. In any case, that's all I have for you. It's a pretty long video. I didn't think it was going to be this long, but I wanted to just show you what we expected, what happened, and this is what I provide for my members. I update them. I let them know when we see these signals. I let them know as soon as I saw the bullish flag take shape here, and it just confirmed our analysis from last week. So hopefully you found it useful. If you haven't subscribed to this channel, I think there should be like a little subscribe link down here. Don't forget to hit the bell for notifications when new videos come out. If you want to check out being a subscriber to the website, like I said, I'll put a link in the description of the video for the website. That website is going to be with us for a little bit longer. You'll be grandfathered in at the current price, and not that's a 2008 price, and not whatever it's going to go up to a little bit when the new site comes out, which will have a lot more features. So with that, I hope you enjoyed the video. Have a fantastic week. Enjoy your holiday for those of you in the US, and I will speak to you soon. Members, I'll see you on Monday. Again, check out that afternoon update from Friday for all of the various market signals or tactical signals looking for a breakout from this bull flag. Thanks a lot, everybody. Take care.